In this video, I want to cover a few things with respect to the gold market and a lot of folks trying to, time the gold market to the upside and, without any sort of edge or understanding of how this space tends to function, at least recently over the past decade. A few things to keep in mind with everything that we do in the markets, and I constantly sort of emphasize that, is we need to have some sort of edge. For example, if you're in the real estate market, maybe you need to have some sort of price edge or leverage your connections, or if you're, a contractor for a living, you can edge out your competition in many different ways. And then in the markets, we do the same thing. We have some sort of edge that we repeatedly execute to get profits out of the market or make a living from the markets. So for this particular gold talk, and this is only specific to gold, it does not work for silver, platinum, copper, any of these metals, soft metals, bonds, energies, you name it. It doesn't work for that. It works for gold. So what you want to do is head over to finviz.com, sort of click this futures, then click metals, and then under metals click gold, and then you'll have access to the daily, weekly, and the monthly chart. So what you want to be doing once you have this up is, I want to cover a few things, is go ahead and read the page on Investopedia with respect to what commercial hedgers are, what large traders are, and what small traders are, and how these metrics are sort of tracked. So this particular edge on the gold market is basically what I'm looking at is every time the commercial hedgers get near this particular zero line. So if I were to draw a straight line through this, so this is our zero line, this blue line, and every time the green line, which is the commercial hedgers, gets closer to the zero, that's an opportunity in the gold market, especially if they get closer or breach zero, which was right around this point. There's going to be some sort of there's going to be positive movement in the gold market, or positive directional movement enough so that we could leverage our capital and make a good amount of money and not get caught up in something like this where gold markets can consolidate for years and years and you don't really get a return on your investment. Now this second area, this was the other time that the commercial hedgers were right near that zero line or turned positive in terms of the net shorts that they had on the gold market with respect to this metric. And again, we get directional movement in gold out of that. So this is a chart that you could have up or bookmark for yourself. And then this data, when commercial hedgers get closer to zero, so if you think about it, this was right around the end of 2015. This is whereabouts, I started trading right around this area. So my first introduction to the markets was sort of the commodity space, which was the toughest space in the markets. And, I used to go for the 3 times USO or GLD or whatever you want to call it. These sort of, the commodity space was sort of the toughest trade in my first introduction, or my, first serious introduction to the markets was this particular space. So this is something that I've used for a couple of years. I tend to buy physical gold right around these areas, and we get big inflection points, or it moves in the gold market when commercial hedgers tend to turn positive. So again, we have an edge. We have defined that edge, and then when that edge shows up, you take action, and once you take action, you get a return. You get a return for having that edge in the markets. And this loop of edge that you define, take an action on, and get a return from has to be repeatedly executed for you to make large amount of dollars in the market. So I hope this helps with respect to what commercial hedgers do. Again, go to Investopedia.com, read about them, read about the gold market, and sort of I tend to wait for these areas to show for me to actually have some sort of conviction. Again, gold trade is one of the hardest trades in the market. There's a lot of people that made money back in the 2000s or 1990s or you name it, were big gold traders or just older in age. tend to love this market because they once made money in that space. And once, making money in the past doesn't really mean that you'll always be sort of, getting a return. The market's got to be cooperative for that. And then this sort of metric that I track helps me out, sort of stay out of the gold market, but be involved when it's ready for bigger moves, and bigger magnitude of moves in the gold market. I hope this helps. If you have any questions, feel free to leave them down in the comments. I'll be more than happy to answer them. I hope this was helpful, and I do want to emphasize that this only works on the gold market.